Hey, what's up, homies? Welcome to another episode of the Homeys Real Estate Podcast. This is your host, Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And hopefully together we can give you a pretty good idea of what's happening in this crazy real estate market. We got a real good one for you. This is a question I get often. What is private mortgage insurance? So I got Angel the lender here. We're going to grill it. We're going to break it down for you. So with that said, Angel, what is private mortgage insurance?
Yeah, we kind of touched on this a little bit last podcast. Today we really want to get into detail on it, right? So first and foremost, private mortgage, PMI stands for private mortgage insurance. You're going to hear that often when you're, shopping for a loan. They're going to, lenders or other individuals that have a home already are going to constantly say PMI. So again, that stands for private mortgage insurance. PMI is strictly for conventional loans, right? So FHA loans do not have PMI. They do have mortgage insurance, but a different type. It's called mortgage insurance premium or MIP, right? So PMI is strictly for conventional loans, right? And basically what PMI is, PMI is an insurance that you have to pay when you as a home buyer don't put at least 20% down on your home, right? Or you don't have 20% equity on your home, you're gonna have to have PMI. And essentially what it is it's an insurance that these insurance companies basically are protecting the banks in the case if you were to default on your property, you weren't able to make your payments anymore, right? It doesn't necessarily stop them from foreclosing on you, right? But it just assures the banks that if you stop making your payments, that they're going to get their money back, right? So that's what the whole purpose of PMI is.
Gotcha. That's really important to note right there. Angel said private mortgage insurance is strictly for conventional loans. A lot of people tend to confuse PMI for FHA loans. FHA loans have mortgage insurance premiums, which we'll break down in our next podcast. So this is strictly for conventional loans. I want to emphasize this. PMI is for conventional loans. Angel, how much does PMI cost?
So PMI, it's going to really depend on a couple factors, right? And how much it costs. So how I like to tell it, and I think I mentioned in the last podcast, it's kind of like when you're shopping for an insurance, right? For example, a car insurance. So if you have perfect, history, when no tickets, no speeding tickets, no car accidents, you're gonna have cheaper insurance, right? Mm-hmm. Same thing for PMI. If you put a larger down payment, then your mortgage insurance is going to be cheaper because you're going to be quicker to that 20% equity, right? If your credit score is higher, you obviously have better credit worthiness, showing that you're going to be making your payments, so it's going to be less risk to these insurance companies, right? To these mortgage insurance companies. Some I also know take into account debt to income ratio. Are you qualifying for a loan that is at your maximum, at the maximum that you could qualify for, or are you qualifying for a home that's maybe a little below your means, but you feel comfortable with that payment, right? So sometimes that gets factored into mortgage insurance. So with mortgage insurance, how much it costs really depends on those different factors. So the higher down payment, if you're putting 10-15% down, depending on your purchase price, you're probably looking at a mortgage insurance in a range between $150 to $300, right? Maybe even less, $100. I even seen sometimes for $75, $60, really cheap mortgage insurance. But when you're putting only 3% down or 5% down, that's when mortgage insurance tends to be higher. That it goes up to usually a $200+ range at that point. But it just depends. It also depends on the mortgage insurance companies. Again, there's different mortgage insurance companies. Different banks use different mortgage insurance companies, right? So I know at my bank we have, I think, about 5 or 6 mortgage insurance companies that we can shop with. So every bank has different mortgage insurance companies that we can check their rates with. Gotcha.
That's a great breakdown, Angel. So to reiterate, they're going to be looking at 3 things, right? So your loan to value, or how much you're putting down, your credit score, and then sometimes your debt to income ratio. The more you put down, the less you're going to be paying towards your PMI. The higher your credit score, usually the lower your PMI. And then the better your debt to income ratio, right? So the lower it is, usually the better your PMI. Angel, so percentage wise, do you have an idea how much that percentage is to the original loan amount for PMI? You have an indicator?
Mortgage insurance always goes by percentages, right? So usually when it's about 10-15% down, you're looking at a mortgage insurance rate of about 0.2 to, I would say, 0.4, somewhere around there. That's usually around and somewhere in that range when you're doing, the 3%, 5% down, it's a little higher. Probably looking at about 0.6, 0.7, somewhere in that range.
Gotcha. Okay, that gives you a pretty good idea of how much you're going to be paying. So you just multiply your loan amount by that 0.5, for instance, and then I'll give you how much you're going to be paying for your mortgage insurance. Now, there's different types of PMI, correct?
Different types of ways to pay the PMI. Correct?
Gotcha.
Yeah.
Can you break them down for us?
Yeah. So first it's called borrower paid monthly PMI. So pretty much what it is it's just like an extra payment on your monthly mortgage, right? So you're gonna have an extra section on your monthly payment that's gonna be strictly for your mortgage insurance payment. So that's one way to pay your mortgage insurance, and that's pretty much the most common way people pay for mortgage insurance. The second one is called lender paid mortgage insurance. So this one's a little tricky because in the way it's termed, it's saying the lender's paying for your mortgage insurance. So it seems like you're not paying for it, right? But really you do pay for it, but how you pay for it is it doesn't show as a column anymore on your mortgage insurance, on your mortgage statement, right? Instead, what the banks do is they increase your interest rate to cover your mortgage insurance. So even though you don't have a mortgage insurance payment, your principal and interest payment is going to be higher because you are taking on the higher interest rate.
Gotcha. And then there's a single premium mortgage insurance. You know what that is?
Correct. Yeah. So single premium mortgage insurance is basically, instead of having a monthly installment, you pay for your mortgage insurance upfront, a one-time fee upfront, and you don't have to worry about monthly mortgage insurance for your life of your loan, right? I really like this option when you're putting 10-15% down, because it's actually usually pretty cheap if you have good credit and you're putting that large down payment. It's not too expensive, and you don't ever have to worry about it in your mortgage. And then the last one is a split mortgage insurance, which is very uncommon. I've never really done any like this, but I do know of it. So basically, you pay you pay a higher fee up front of mortgage insurance, right? So kind of like the single premium. You're paying a single premium up front, but then you're also going to pay some in your monthly payment, right? So you're going to have, but it's going to be a smaller amount because you paid a large sum up front. So that's also an option.
Gotcha. So of the four, which is the most popular, or which two are the most popular?
Usually it's borrower paid MI, borrower paid mortgage insurance, which is the monthly one, is usually the most common. It's easiest for everybody. You don't have to worry about coming in with more money at closing, right? You pay it every month in your payment. If you're comfortable with that payment, it's easy just to make it. And then the single premium is one that I like to push for borrowers where it makes sense. Again, with that 10%, 15% down. Sometimes it only costs them like $3,000, $4,000 up front, right? And you never have to worry about mortgage insurance ever again. Instead of having $100, $150 monthly payment, you just get rid of it up front. So it just depends. Everyone's different though.
Gotcha. Thank you. That breaks it down for us as well. So remember, there's four types of PMI: borrow paid mortgage insurance, lender paid mortgage insurance, single premium mortgage insurance, and then split premium mortgage insurance. So Angel, how do you make payments on your PMI? I know that for the single premium mortgage insurance you pay it up front, but for the rest of them, how are those payments made? Yeah,
so again, the other one, lender paid, you're going to pay it in your principal and interest, so you're paying it every month in your payment. Your borrower paid MI is going to be your monthly mortgage insurance. You're going to pay it every month, right? Single premium, you pay it at closing. So when you're closing your loan, you're going to pay for that mortgage insurance fee up front as part of your closing cost. And then the split premium is a portion, again, is going to be paid in your closing cost, and then a portion is also going to be paid in your monthly payment. Mortgage insurance too, you have, I never really see the option. I don't really see anybody doing it, but you can pay, your mortgage insurance upfront for a year. I know some banks offer that, or you can just pay your mortgage insurance in your monthly installments, whatever you would like to do. I've never seen anyone do the single every year or pay it one time a year. It's usually built into that payment. Just makes it easier for a borrower to know that their payment's gonna be made every month.
Gotcha. Thank you, Angel. Do all lenders require this private mortgage insurance?
Yeah. So every lender, that I know of, there's some programs that I've heard of, for other banks offering that there's no mortgage insurance required. I can't confirm nor deny it. I'm not sure. But special programs, it has to be these special programs. But for the most part, every bank's going to require a mortgage insurance. Yeah.
Gotcha. If you put down less than 20%.
On a conventional loan.
Yeah.
On a conventional.
So remember, for the FHA loan, it's a different type of mortgage insurance premium. VA loan, there is no mortgage insurance. So that gives you a pretty good idea. Is there an advantage to paying this private mortgage insurance, or should I just wait till I have 20% so I don't have to get mortgage insurance?
Yeah, so it's definitely better to pay that mortgage insurance, right? Like me and Anthony have stressed throughout this podcast since we started it, is it's best to get a home and build equity on that than waiting to have 20% down, and your money that you're saving up is going against appreciation, right? Whereas you can purchase your homes, continue to save money while you're in your house, and also let your home appreciate, right? Because of course, we're going to talk about in a little bit, but there's ways to remove PMI. So it's best to get in the home as soon as you can and pay that PMI.
Absolutely. So if your home is in an appreciating market, right, it just makes sense to just pay private mortgage insurance, because typically the home is going to appreciate at a much more rate than what you're paying for your private mortgage insurance. Because your private mortgage insurance is going to be maybe $500, $600 depending on what your loan amount is and what your qualifications are. And a home appreciating, let's just say conservatively at 3%, a $500,000 home, that's $15,000 after a year. So if you break that down, that's about $1,200-ish, maybe $1,500 a month. So that's much more than what your private mortgage insurance fee is. Angel, is Pmi tax deductible? This is a really good question.
Yeah, so according to the bankrate.com, they're saying that it is, that you have the ability to, starting in 2021, to tax, that PMI is going to be tax deductible, right? So it says right here that it does phase out after your adjusted gross income reaches $100,000. To be honest, I'm not exactly sure of it. Something you should ask your tax preparer, and I'm sure I'm going to get a lot more questions about it, this year once the taxes are getting done, if people can deduct PMI. Yeah, I'm not 100% sure how that works as far as taxes goes.
Gotcha. And then the final question, a question that I'm sure everyone is wondering: how do I remove this PMI? Right? Like, once I get to 20% equity, is there a way that I can remove this mortgage insurance premium or this private mortgage insurance? Angel.
Yeah, so of course there's definitely different ways to remove PMI. One of the most common ways right now with homes, building equity and going up in value, is people are refinancing, right? Refinancing to remove that mortgage insurance, along with right now lowering their interest rates. So you can refinance it, refinance your home. You could also, usually the banks are going to require you to have at least 5 years of making your payments. But say in 5 years after you've been making your payments on time, you can call your mortgage service provider and ask them if they can remove your mortgage insurance. Tell them, I already have the 20% equity because my home has appreciated over the last 5 years, and my loan principal has obviously gone down with my monthly payments, right? So with those two things happening, there's a good chance in 5 years, unless something in the market crazy happens, something crazy in the market happens, it should definitely be removed at that point. You can also, while you're doing that, they may ask you to get an appraisal done, right? So you can get your home appraised by, obviously, a certified appraiser. He'll let you know the current value of your home today, and you can also send that into the bank as evidence. Hey, my home is at that 20%. Another way, which is I don't recommend this way, for the most part, is just making your payments every month, right? Eventually, your balance is gonna reach once it reaches 78% loan to value, it is required for the banks to remove your mortgage insurance. So it'll automatically fall off, right? But that's going to take a long time with you making your principal and interest payments. It's quicker just to do it either refinancing or waiting 5 years, to see if you can remove it. Also, just call your mortgage service provider, any of you guys that do have homes that are interested in removing it, and see what the process is with them, right? Maybe they don't require 5 years. Sometimes they require 3 years, but you have to have like 85% equity. There's different ways around it.
You mean 25% equity?
Excuse me, 25% equity, 85% loan to value. Yeah, thank you.
75% loan to value.
Oh my goodness, I'm so sorry. My math is off this morning. Yes,
no worries.
75% loan to value, 25% equity. They'll let you remove it. So just talk with your mortgage service provider and see what they can do for you.
Perfect, Angel. Thank you for that. So to reiterate, there are 4 ways to remove PMI, right? The first way is just to build equity over time. Principal pay down once you get to 75%. Loan to value or 22% equity, you should be able to remove it. Number 2 is contacting your service provider once you get 20% equity, see what the process is. You might be able to remove it then and there. Number 3 is to get your property reappraised. Now, Angel says that typically you have to wait 5 years, depending on the bank. It could be shorter, it could be more. To get the property reappraised, usually costs around $500 or so to get the appraisal done, but it makes sense to save you, $500 plus dollars monthly. And then the last thing and the most popular is refinancing your mortgage, especially in this market right now, where they can take into account how much your home has appraised or appreciated over time, what your principal pay down is. If it's over 20%, you're good to go, and you can most likely lock in a lower rate because we have very competitive interest rates right now. So, Angel, what's the bottom line about private mortgage insurance? If there's one thing that you wanted to drill down and get everyone to know, what would it be?
That really, if you have the means of getting into a home, but that is going to require you paying mortgage insurance, it's best to get your foot in that door. It's best to get your own house, build that appreciation. As you can see, there's multiple ways to remove that mortgage insurance, right? And trust me, I had a client the other day that was saving up money, and she thought she had the money now, but then the homes have gone up, and she still makes the same amount of income, so she doesn't qualify for more than she did a year ago, right? Or so what basically is happening is she's saving up money, but the home prices are going up, so she's gonna have to keep saving up more money, right? Just getting your home with this mortgage insurance, pay it. And just, again, like I always say, let appreciation do what it does, and you can get rid of this. It's something you don't have to have forever. And again, how we always stress, if you're comfortable with your monthly payment, don't be scared to take that step towards home ownership.
Absolutely. Angel nailed it again. Don't work against appreciation. Let appreciation work for you. So as long as you can make that monthly payment, you should go into your home, right? And then it'll be a matter of no time that you'll be able to have that 20% equity and do whatever the process is to remove that private mortgage insurance.
And one thing too, as you can see too, there's a lot of different options as well. So people who don't want to pay for it, but they don't have the 20% down. Maybe you have enough for 10% down, but you also have enough to pay it up front, so you don't have a monthly payment. So remember, there's different options here where you don't have to necessarily have a monthly mortgage insurance payment. So remember, you can also, when you speak to your lender, go over the different options that are available to you when it comes to mortgage insurance.
Awesome. Thank you, Angel. So, Angel, where can we find you?
Your Mortgage Angel on Instagram.
At Your Mortgage Angel on Instagram. You know where to find us, at the Luevanos Group. This is Anthony.
This is Angel.
I want to wish you all the best. Take care and stay safe.
Thank you.
Hey homies, it's Anthony. This podcast contains my opinions and is for educational purposes only. It does not guarantee any projections and should not serve as a basis for any purchase or sale in real estate.